Welcome back to the deep dive. If you're familiar with the blockchain world, projects rarely sit still, but what we're looking at today isn't just an update. It's a complete metamorphosis. We are diving deep into Horizen, or ZEN, a platform that has evolved dramatically since its start back in 2017 as Zencash, a privacy coin.
And that transformation is really the entire story here, isn't it? The original ZN was basically a fork of Bitcoin. Secure, yeah, but kind of slow. The Horizen we're analyzing now is fundamentally focused on delivering scalable, compliance-aware privacy as a modular layer 3 ecosystem. It's a complete shift, really, in infrastructure and philosophy.
Yeah, absolutely. So our mission today is to unpack that whole journey. We need to understand the initial blockchain of blockchain's architecture, analyze the seismic 2025 pivot to Base, which completely changed where and how it operates, and look at the complex governance structure that kind of keeps this evolving machine running.
Right, and the central conflict Horizen is tackling is, it's fascinating. How do you deliver enterprise-grade confidentiality and, business privacy while also satisfying the demands for auditability and regulatory alignment? Most protocols kind of have to pick a side. Horizen's modular approach, separating the core security from the functional logic, that's their attempt to bridge that gap and, overcome the inherent scaling limits of older Bitcoin-derived chains.
Okay, let's unpack this then, starting with the original design. Before this big move, Horizen was built on a main chain and multiple side chains. How did that foundational layer manage to deliver, massive scalability and decentralization?
Well, the architecture really mandated simplicity for the core. The main chain's job was basically to be a supreme truth engine. It was a Bitcoin-like blockchain using equihash proof of work. That was an algorithm chosen years ago, partly because it's slightly more memory hard, aimed to be more resistant to centralized ASIC mining than, say, standard SHA-256. The main chain didn't really process application logic. It simply provided the universal token of value, ZBN, and adjudicated whether the side chains were running fairly.
So the core was this highly secured, almost minimalistic base layer.
Right.
What specific measures did they take to secure that proof of work core against threats like, say, a 51% attack?
Yeah. They enhanced the standard Nakamoto consensus with something called the delayed block penalty algorithm. Think of it like this. A typical 51% attack involves a malicious miner secretly building a longer chain and then, bam, dumping it onto the network to reverse transactions. The delayed block penalty actively punishes miners who submit blocks late. If you're mining blocks in secret, by definition, you're delaying their submission. This penalty makes conducting a successful block reorganization prohibitively expensive and, frankly, highly visible.
That sounds like a pretty powerful defense for the core, yeah. But the modularity meant the real innovation kind of lived on the sidechains, right? These sidechains were fully decoupled and could use any consensus mechanism. Proof of stake, DGs, different programming languages.
Exactly. That decoupling is sort of the genius of the initial design. It's a security feature, really. If a sidechain, maybe one running some highly experimental DeFi application, gets hacked or develops a bug, that security event is isolated. It affects only that sidechain's assets and logic, leaving the main chain and all other sidechains completely unaffected.
Right, okay. Now we get to the movement of funds, which is always the biggest technical hurdle in these systems. To connect the main chain to these diverse side chains, they invented the cross-chain transfer protocol, or CCTP. Can you explain that mechanism a bit?
Sure. CCTP is essentially the standardized two-way toll bridge for ZIM. It's required for any sidechain integration. Fundamentally, transferring Zion involves a simple one-to-one burn and recreate mechanism. When you send Zion from the main chain to a side chain, you essentially lock or burn the coins on the main chain, and the side chain then mints an equivalent amount. Forward transfers are pretty easy. The main chain sees a request to lock the coins and trusts the side chain will mint them.
Okay, that makes sense. But the real challenge, the backward transfer, sending funds from a side chain back to the main chain, that seems like it requires some serious cryptographic innovation. You said the main chain is designed to be oblivious to the side chains. So how can it trust that the side chain has correctly burned the coins before releasing the main chain funds?
That's the core trust problem Horizen solved, yeah. They couldn't rely on a single entity, obviously, so they used withdrawal epochs, which function kind of like decentralized escrow certus windows. An epoch is a set time interval split into two phases. In the preparation stage, users submit withdrawal requests. Then, in the signing stage, all those requests are aggregated into a single, compact cryptographic proof. They call it a certificate.
Okay, so the sidechain produces this certificate.
Exactly. That certificate is then sent to the main chain. Now, the main chain doesn't need to know the entire history of the sidechain or every single withdrawal request. It just validates the mathematical proof within that certificate. If the proof is valid, the main chain can release the corresponding coins without needing to know how the sidechain consensus generated it. It's trustless and decentralized. Pretty clever stuff.
That interoperability mechanism is clearly powerful, yeah. But we need to talk about the massive shift in 2025. Despite having this secure and, frankly, novel proof-of-work architecture, the Horizen DAO voted to completely change the foundation. So what was the driver behind abandoning that original PowerCW structure for Horizen 2.0? Why the big change?
Well, the old architecture, while secure, was ultimately just too slow and lacked the native compatibility needed for the next wave of DeFi and, importantly, in enterprise adoption. The core issue was EVM compatibility and speed. The decision was essentially to deploy Horizen 2.0 as a Layer 3 and L3 appchain on Base. And Base, as you know, is an Ethereum Layer 2 developed by Coinbase.
Base specifically. If they were looking for modularity and speed, why Base over, say, other popular modular chains like Polygon or Avalanche? Was that institutional connection the deciding factor here?
I think that's the critical analysis, yes. Base, being integrated so tightly with Coinbase's ecosystem, carries significant institutional gravity. The sources we looked at confirm this trajectory. They noted the ZN token migrate to an ERC20 token on Base back in July 2025, keeping the 1-to-1 claim ratio. This move immediately improves liquidity and integrates Horizen much more deeply into the established Ethereum ecosystem. Plus, you have that existing institutional partnership, right? Grayscale's Horizen Trust, the HCEN, already uses Coinbase custody for its asset storage. It all kind of lines up.
So we're really watching a project choose institutional compliance and scale, perhaps over the ethos of pure decentralization that comes with proof of work. The vision shifted explicitly to compliant privacy. What does that actually mean in practice?
It's largely a strategic rebranding, you could say. They're positioning privacy not as a tool for, evasion, but as an essential enterprise-grade security guarantee. This means tailoring confidentiality to align with auditability needs. The sources list immediate real-world use cases, things like private stablecoins, encrypted consumer payments, and crucially, they're aiming for confidential DeFi, protecting users from common exploits like front-running and MEV, maximal extractable value. That's planned to be achieved through confidential computing environments slated for Q1 2026.
Okay, moving to the actual tech that makes this compliant privacy work. We often see this long list of cryptographic acronyms. It can get pretty overwhelming. What are the most crucial privacy-enhancing technologies, the PETs, that developers actually use on Horizen 2.0?
Right, let's simplify that list a bit. While they integrate many tools, the two most critical are probably zero-knowledge proofs, ZKPs, and trusted execution environments, or TEs. ZKPs, as many listeners will know, allow a transaction to be proven valid without revealing any data about the amounts or parties involved. TGs are perhaps more relevant to that enterprise focus we mentioned.
How should we think about a T? Can you break that down?
Sure. Think of a T as like a cryptographic black box on a server. It's a secure hardware enclave where code can execute privately, even from the device's owner or the cloud operator. This ensures that sensitive data, even while it's being processed by a third party, remains confidential and can't be viewed or tampered with. It's a hardware-based security guarantee.
That still sounds like incredibly complex cryptography that the average developer probably doesn't want to get bogged down in.
Exactly, and that's why the sidechain SDK and the EVM compatibility are so essential. The whole system is designed to abstract away that complexity. It lets developers use standard languages they already know, like Solidity or Python. Since the smart contract complexity is offloaded to the sidechains, developers can customize everything. They can optimize consensus for specific needs, say, incredibly fast confirmation times needed for a price-stable asset like a ZUSD without messing with the security of the main L3 layer.
And the mechanism that bridges pure privacy with compliance, that's selective disclosure. That's the core compromise, isn't it?
Absolutely. That's the key piece for enterprise. Selective disclosure allows for optional view keys and access logs. By default, transactions can be fully shielded using those crypto tools we discussed. But for compliance purposes, a developer can choose to implement a feature that provides a view key to a specific entity, maybe a regulator or an auditor. This tailors the privacy level to meet regulatory requirements without breaking the core security. It's their path to enterprise adoption.
Let's turn to governance then. We've seen a lot of projects struggle with community management, treasury allocation. Who controls the roadmap and the money in this new L3 structure?
Well, the Horizen DAO, which is composed of ZN token holders, is the central authority. It's managed via Zen Improvement Proposals, or ZenIPs, and they've actually implemented pretty significant barriers to entry, seemingly to ensure that only serious proposals get considered.
Yeah, let's look at those requirements because they are substantial. Requiring 25,000 ZN for just a non-technical proposal and a whopping 100,000 ZN for a technical ZenIP. That sounds like you could centralize power among the big holders, the whales.
Yeah.
How does the structure prevent this from becoming just a plutocracy, even with that special counsel check you mentioned?
That's a fair point. It certainly sets a high bar for proposal creation, centralizing the right to propose among large holders. However, the system relies heavily on high voting thresholds to prevent a simple majority of whales from pushing through unpopular or maybe even dangerous changes. For non-technical proposals, you need a 3% total circulating supply quorum. That's quite a few votes. For technical ZenIPs, the ones that actually alter the core code, the threshold is much steeper, 67% in favor, and a 5% total circulating supply quorum. These high quorums basically force broad consensus across the community, not just among the largest holders.
And there's also that critical oversight mechanism, the special counsel. Tell us about that.
Correct. This is a 7-member group initially appointed by the foundation, acting as a filter and a check on security and mission alignment. They review all ZenIPs before they go to a full community vote. Their powers are quite specific. They can tag a proposal for return for clarification, say if the cost estimate seems way off or exceeds 10% of the public treasury, or more powerfully, they can tag it for return for reconsideration if it violates the DAO's established mission or, applicable law. They're basically the safeguard against malicious or just poorly constructed proposals.
Okay, what about the economics, the fuel for this L3 ecosystem? When they were proof of work, the block subsidy distribution was clear. How is the ZN token rewarded now, especially after the base migration?
The core economic premise actually remains pretty strong. The total supply is deflationary, capped at 21 million ZN, with the block subsidy having every 840,000 blocks, just like Bitcoin. While the old POW system heavily favored miners, the overall reward distribution philosophy still applies to running the network. 20% is dedicated to nodes split evenly, 10% each to secure nodes and supernodes, and another 20% goes to the Treasury Fund for ongoing development and growth.
Right, so the reliance shifts much more heavily onto node operators for maintaining the network and confirming things. What are the requirements for those node tiers?
They are pretty significant, yeah. Secure nodes require a 42 ZN stake and need to maintain 92% availability, ensuring continuous service. Supernodes, which are designed for higher performance and maybe more demanding security tasks, require a much larger 500 ZN stake and need 96% availability. So, serious commitment. It's also worth noting that while the tracking of these nodes was historically centralized, the plan is to migrate this oversight function to a dedicated sidechain eventually, moving that component towards, true decentralization.
Okay. This raises an important question then. Horizen started out in the privacy coin space, which is, let's face it, a competitive and often controversial area. Given this pivot away from pure anonymity toward compliant privacy, some critics might say Horizen has lost its original identity. Is this just a survival strategy, or is it a compromise that goes too far?
It's interesting. The community discussions we looked at definitely confirm that tension. Historically, Monero XMR is widely praised as the, quote, king of privacy, precisely because privacy is mandatory. It's an all-or-nothing approach. If every transaction is shielded by default, then no single shielded transaction looks suspicious. This provides highly robust, chain analysis-resistant anonymity.
And Horizen, along with Zcash, ZEC, often face that criticism because their privacy features were optional, right?
Yeah, exactly. Critics argued, pretty convincingly sometimes, that optional privacy created a small, identifiable subset of users who chose privacy, potentially defeating the goal of network-wide anonymity. The sources also noted Dash isn't really considered a privacy coin by serious analysts, and others, like Verge, were deemed unreliable due to multiple 51% attacks. So Horizen's move seems quite pragmatic. It looks like a strategic reaction to increasing global regulatory pressure, like those proposed EU bans on privacy coins we hear about. It might be the only viable path towards serious enterprise adoption, even if it means stepping away from that pure privacy ethos. They seem to be betting on enterprise adoption being a much bigger opportunity in the long run than perhaps maintaining philosophical purity.
Right. This has been quite a journey to follow, from a standard secure Bitcoin fork with these novel sidechains all the way to an L3 on Base, betting the farm on modularity and compliant privacy for institutional adoption. It really is the story of a project seemingly prioritizing survival and growth within the current regulatory landscape, maybe over some of its original revolutionary principles.
And I think that's the final provocative thought we can leave you, the listener, with. The core tension in this whole Horizen evolution is that balance between achieving mass scalability and market adoption, which often requires regulatory compliance, versus sticking to the original ideals. If compliant privacy, meaning features like optional view keys, is truly necessary for businesses and institutions to actually use the platform, well, does this structural need for external auditability fundamentally undermine the original vision of cryptographic financial freedom? Or is this kind of controlled, audible privacy the only sustainable path forward for blockchain tech in the mainstream? Something to think about.